So Jeremy from Financial Education invested 70 grand into one stock, Dropbox. Should you be doing the same? Hey, and welcome back to another video here at FiscalVoyage. My name is Felix, and in today's video, I actually was watching a video from Jeremy from Financial Education, and he just invested 70 grand into Dropbox. So I looked further into Dropbox, and I think he did a pretty good decision because Dropbox is growing very rapidly. So this video is going to be a quick stock analysis on Dropbox. It's just going to look at some numbers, some growth. Before we get started, I have a free ebook in the description called 5 quick metrics to look for before spending more time in investing in a particular company. So check out that free ebook in the description below. So let's get started with the analysis on Dropbox. So here's the video that Jeremy put out from Germany from Financial Education channel, where I just put 70,000 in new $20 growth stock, and the growth stock was Dropbox. So I watched this video, and he brought some good points, and if you guys don't know who he is, make sure to go to his channel, real good channel. And so I was decided to let me look into this and do more research on Dropbox and see why did he spend 70 grand in this one stock. So first off, if we look at the stock here of Dropbox, right now it's at $20.02. Actually, it was a little lower earlier this morning. Got up to like $19.60 or somewhere like that. But this is a cloud company that holds storage. Actually, in my last job, we used this company for our collaborating, file management, things like that. So it's a real good system, and it got as high as $22.45 before the economic shutdown, and it got as low as $16 or $15.69, and it's got up, but then now it's on a downtrend. But it's in the technology space, and as we all know, the technology stocks has been going out of control because work from home and things like that. So this might be a good opportunity to take advantage of a technology stock that hasn't perform as some of the other ones, big names like Microsoft, Apple, Adobe, think companies like that. So this might be a good opportunity now. And let's look at some of the earnings report and annual reports from this company. So over here is the press release for the fourth quarter and fiscal 2019 results. And for the fiscal 2019, revenue was 1.66 billion, up 19% year over year, and net cash provided by operating activities of 528 million, and free cash flow of 394 million. And this is great here, and I'll look at that shortly later in the cash flow statement. But cash flow is looking real good, and they're expected to continue growing that cash flow. So that's great for the stock price. So this is the operation statements here, and you can see here the company had a net loss of 52 million for 2019 and a 484 million loss in 2018. So they are making progress, and actually the first 6 months for 2020 they have a net positive profit. So they're making profit now for the first half of 2020. We'll look at that shortly from their last quarter for the second quarter release for 2020. But as you can see here, the company for the past 2 years has been negative, and if we look at the Morningstar report here, net income has been negative since 2015. So they've been losing money since 2015, but just recently they have started to make a profit. So we look at the balance sheet here. You can see the cash on cash equivalents. They have 551 million for the end of 2019 compared to 2018, 519 million. So that's positive there. Total assets also increased. It looks like it doubled. Total asset increase, and most of this increase came from operating lease right-off use assets, and as well as the property and equipment assets. And on the liability section, it did increase. Total liability increased about 800 million. So most of that came from the the total current liabilities, which was from operating lease liability, as well as accrued compensation and benefits. So increases like that drove up the total liability. But they do have more assets than total liability. The current ratio, let's take a look at that, is 2699 divided by 189 is 1.4. So that's right about that 1.5 area that we like to look for. But the 1.4 is okay. And let's look at the debt to equity ratio, the total liability divided by total shareholder equity, which is 8.4, which is 2.3. So that's quite high for the debt to equity ratio. But the company is growing quite tremendously with the revenue growth, and we'll look at more at the fast graph and how they're doing for the second quarter. So this is based on 2019 fiscal year. So it's for the 2 quarters for the first 6 months for 2020. It's much better debt to equity. So let's look at the first second quarter 2020 financial results. You can see here revenue grew at 16%. Let's look at the statement here, and as you see here, the company for the first 6 months and in June 30, the company actually has a net income of 56 million versus 2019's first 6 month loss of 29 million. Let's look at the cash flow for the first 3 months ended June 30th. You can see here the company had a much better cash flow from operation, almost 20 million higher than the first or the second quarter for 2019. So minus the 26 in CapEx, you have a nice free cash flow of let's see here, about, let me see, 145 minus 26. Wait, 145 minus 26 is about 119 million in free cash flow. So it's definitely an increase from the 2019 second quarter, as well as a free cash flow increase for the first 6 months of the fiscal year 2020. So that's very positive. So overall, the company is looking really good. Free cash flow is growing, revenue is growing, they're making a profit now, so it's very promising. So let's look at the fast graph for this Dropbox company. So you can see here the black line is the monthly closing price, the blue is a normal PE of about 42 versus a earnings PE of 48. So you can see here when the company first initially IPO, it was about $30. Let's see what we got here, $31.25. So it's been down since then about negative 35.5% total return. So it's not been a good investment since its IPO. That's why sometimes it's important to give a company maybe a year or so after its IPO before you really want to invest in it. A lot of time with IPOs, people just want to take advantage of the news and take a quick profit. But right now, the company looks very promising, as you can see here. Earnings for 2020 is expected to be positive at adjusted earnings at 77 cents, which is a 54% increase from the 50 cents that it earned in 2022. So that's real good. And then 2021 is expected to be an 18% increase to 91 cents a share. So if we look at make this chart a little better looking here, the company has a possibility of great return of about 20% annual rate of return. This is based on yesterday's closing price of $20.16. So the growth is there, and if we look at the forecast, analysts are expecting about 34% growth. This is again just from one analyst, but that's very promising. You can see here you could have a great total return, about 30% by 2022. So I can see why Jeremy put 70 grand into Dropbox. It looks very promising. I personally, I'll talk more of my decision later on in this video, but it doesn't pay a dividend, so that's right there. It's something that I don't like. The debt to cap ratio is pretty decent here at 48%. But overall, the company looks good. I could definitely see this company growing much higher. As you saw, Dropbox has great potential for growth. It's been lacking over this year. As you know, most technology company has been increasing share price very rapidly, but Dropbox has been decreasing or fairly flat since the beginning of the year. I'm personally not buying shares of Dropbox because it doesn't pay out dividends. I'm trying to reach a goal of about $2,000 in pure dividend income a month. Averaging, so about $24,000 a year in dividend income. So I'm trying to reach that goal first before I invest money into companies like Dropbox, which would be like a growth company. But if you have room in your portfolio and you do invest in growth company, I highly recommend checking out Dropbox because I think this company is going to have a great return in the next 2-3 years. So I think Jeremy did a great move on buying shares of Dropbox. Eventually I will start buying companies, a growth company, again, once I reach that $24,000 a year in dividend income. Overall, Dropbox looks great. I highly recommend you guys to check it out. And again, if you have room in your portfolio for a growth company, definitely check out Dropbox. It's coming out real good. Earnings are looking good. Free cash flow is looking good. Revenue growth is looking good. The debt is manageable. So it looks real good. So you guys should definitely look into it. So thank you for watching, and if you're new to the channel, make sure to hit that subscribe button, and I'll see you in the next one.